Is the Bajaj Allianz Life Capital Gold Suraksha plan the perfect combination of flexibility, returns, and financial protection you have been looking for? Let's find out through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decision to reach your financial goal in a more faster and smarter way. Now, before analyzing this policy, let us first understand what is this policy is about. So basically this policy is a combination of two individual products named Bajaj Allianz Life Goal Assure 2 and also a Bajaj Allianz Life POS Goal Suraksha plan. So one is a unit linked non-participating individual life savings insurance plan and another product is a non-linked non-participating individual life insurance savings plan. So the combination of these both products is this policy. Now let us take a look at the features of this policy. You can enjoy life cover throughout the policy term. A portion of your investment provides guaranteed returns and there are benefits from a fund booster at maturity to enhance your returns, and you can also receive a refund of mortality charges upon maturity, and you can earn market linked returns on your investment, and you have the flexibility to choose your limited premium payment term. So these are all some of the features of this policy. Now let's take a look at the benefits. So there are two kinds of benefits. One is a death benefit, another is the maturity benefit. Death benefit is something the nominee or the legal heir will get if the policyholder unfortunately passes away during the policy term. Here the sum assured on death will be paid to the nominee as the death benefit. The maturity benefit is something the policyholder will get once the policy matures. So here the maturity benefit includes both guaranteed and non-guaranteed benefits. Now let us take a look at the various fund options are available under this policy, which are Equity Growth Fund 2, Accelerator Mid Cap Fund 2, Pure Stock Fund 2, Asset Allocation Fund 2, Blue Chip Equity Fund, Bond Fund, Liquid Fund, Flexi Cap Fund, Sustainable Equity Fund, Small Cap Fund, Mid Cap Index Fund, Dynamic Asset Allocation Fund, Small Cap Quality Index Fund, Individual Short Term Debt Fund, and Debt Plus Fund. So there are 16 fund options and they are categorized based on the percentage they have to different asset classes like equity, debt, money market, and also according to the risk profile they have, which can range from moderate to very high. There are also various charges under this policy. There is no premium allocation charge, but we do have charges for topping up your premium, and also there is something called policy administration charge, which is at least a maximum of 500 rupees per month, and this charge will be deducted at each monthly anniversary by the cancellation of units at the prevailing unit price. And also there is fund management charge, which they charge based on the fund you have chose and how much risk profile it has. Like if it is high risk, there will be slightly different charges or slightly higher charges compared to moderate risk profile funds. So it can range from 0.50% to 1.35%. And there is also miscellaneous charges where they charge at least 100 rupees per transaction in respect of alteration of your premium mode or alteration of your premium apportionment or change in portfolio strategy or change in premium paying term or even decrease in sum assured. These all shall be charged. So the thing is, all these various charges are similar to any other ULIP, but the thing is, these charges can significantly diminish your returns over an extended period of time. So this highlights a noble contrast when compared to invest in other market related instruments. Now let us take a look at the advantages and disadvantages of investing in this policy. So the advantages are you have the flexibility to customize your premium payment term and policy duration to match your financial goals, and you have the option to choose funds that aligns with your risk appetite, ensuring personalized investment strategies. So these are some advantages. The disadvantage are only a portion of your benefits is guaranteed. Loan facility is not available under this plan, and the sum assured may also be insufficient to meet your family's future financial needs. So these are also some of the drawbacks that you need to carefully consider before deciding to invest in it. Now let's move on to the analysis part of the video, as we have a basic understanding of this policy. What we are going to do is, to get a proper idea of whether investing in it will be worth it or not, first we are going to calculate the internal rate of return IRR of this policy, and then compare it with other market linked returns to gauge its real performance and also to help us make a more informed decision. So a comparative analysis will seal the analysis part, but first we will start with the IRR analysis. So let us for example assume that a 30-year-old male opts for this plan, paying an annual premium of 1 lakh for 5 years. So this policy term is 15 years with a sum assured of 10 lakhs. So now, as the guaranteed benefit at maturity is 5 lakh 916 rupees, but there are also non-guaranteed benefits. So for that we are going to calculate at a future assumed rate of return like 4% and 8%. These are not guaranteed returns, or they do not reflect the potential range of outcomes that can come out of this policy. This is just to indicate a worst and best case scenario to give you a better idea. So at 4% worst case scenario, the non-guaranteed benefit amounts to 3,49,122 rupees, making the total maturity benefit 8.50 lakhs with an IRR of 4.15%. At the best case scenario, 8% return scenario, non-guaranteed benefits are 35,62,623 rupees, bringing the total maturity benefit to 10.63 lakhs with an IRR of 5.95%. So while this plan is market linked, its returns are significantly lower than the inflation rate if you take a look at the returns. That's why this makes it an inefficient option for wealth accumulation over the long term period. Now, as we know, this policy is not giving us a desirable outcome we need. What we are going to do is, now we are going to evaluate the returns from alternate market linked investment with the alternative investment approach. Like, instead of investing in an insurance cum investment plan like this, we are going to separate life in. So a pure term life insurance policy is a cost effective option for life cover. So we are going to opt this for life cover. For example, a policy with 10 lakh sum assured cost 8,500 rupees annually, whereas we paid a premium of 1 lakh in the Bajaj Allianz policy. And this is payable for 5 years with a premium policy term of 15 years. So if you compare the premium with Bajaj's premium, this approach leaves you with 91,500 rupees annually for investments tailored to your risk appetite. So if you are a high risk investor, equity investments such as ELSS funds are a viable choice. If you are a low risk investor, debt instrument like PPF offers stable returns. So in this analysis, we are going to consider ELSS, which is also a market linked product, for a fair comparison. So after 15 years, the ELSS investment grows to a pre-tax maturity value of 20.22 lakhs, which, accounting for capital gains tax, the post-tax maturity value is 18.42 lakhs. So combining the pure term policy and ELSS, the IRR stands at an impressive 10.47%. So this comparison highlights that separate investment can deliver inflation-beating returns and greater liquidity. On the other hand, this policy falls short in both returns potential and liquidity, making it less effective for wealth accumulation. So what is the final verdict on our analysis in this policy? Is this worth investing or not? As you can see from our analysis, this policy offers a way to channel savings into the market while providing a portion of the benefits as guaranteed returns. However, the projected returns are lower than the inflation rate, making it an inefficient choice for long-term wealth accumulation. So in market-linked investments, returns should align with the level of risk. So unfortunately, this plan exhibits a mismatch between risk and return, which can negatively impact your long-term goals and overall financial strategy. Additionally, the sum assured under this plan is inadequate to secure your family's financial future, leaving both the insurance and investment aspects unconvincing as a viable option, and it also has a huge agent commission. So that's why you can avoid investing this policy and instead opt for a pure term life insurance policy, because it is a much more suitable choice for ensuring financial protection. So by selecting a sum assured based on your liabilities and goals, you can provide sufficient financial security for your family against unforeseen events. And pure term policies also comes with affordable premium rate, making them a cost effective solution. And for wealth accumulation purpose, it is better to build a diversified investment portfolio tailored to your risk appetite, financial goals, and investment horizon.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.